Hello, my friends. Brett Pattison coming at you with Brian Hunsaker, Spencer Nelson from the financial capital of the West, and Spencer is in the great Cache Valley, Utah. Coming at you on Zoom today. Zoom, because we're all in different places, and we really wanted to, in the midst of a lot of volatility, we'll just say that. We wanted to get a podcast out to everybody today and didn't want to wait. So we are using Zoom. So Brian, Spencer, everything good?
Doing all right.
We're doing okay, Brett. It's a tough day in the market, but we're doing okay.
All right, let's talk about the market because that's what everybody's wondering about. And I'm going to share with you my screen for anybody watching on video, and then we'll talk about what we're sharing. But if I share my screen here, I'm going to bring you to year-to-date returns. And I've got a couple different asset classes up here. We've got the S&P 500. We've got the NASDAQ. We've got the core bond index. AGG is the ETF. And then we've got 20-year treasuries. And I wanted to highlight year-to-date returns and everything just to illustrate a point. The S&P 500 year-to-date is down 13.59%. The NASDAQ year-to-date is down 22%. It's about 25% off its highs, but year-to-date is down 22%. Now, here's the crazy thing that hasn't happened since 1920, I've read, which is bonds are off to their worst start to a year since 1920. And the aggregate bond index is down 10.79%. From its highs, it's down equivalent to the S&P 500. And the 20-year treasury, where a lot of people go to find safety, is down 22.5%, more than the NASDAQ year to date. So really, guys, there's been no place to hide, right? For investors, bonds or stocks, there's been nowhere to go. And Brian, you said, well, let's take a look at a 1 year. Well, here's your 1 year chart. Bonds are over the last 1 year have significantly underperformed the markets, down 11% and 17% compared to the market, which has given up all its year's gains and is down. So first off,
basically the S&P's flat over the last 12 months versus bonds down between 10 and 15%, and the NASDAQ's down about 6%. Yeah.
Yep. And it goes back to what we've said about bonds, and I don't want to harp on that, right? We haven't liked bonds for a long time. This is why, because we knew the perfect storm was brewing. But I think the more important thing here, Brian, and I'll turn to you first, is investors, you know, are nervous. No matter who you are, you're nervous. And so speak to what's happening in the market right now. And with all this chaos happening, I mean, the NASDAQ, Spencer, you might be looking at it right now, down 5.5% today. Is that what you're seeing?
Yeah, 5.7 is where I saw it a second ago.
So closer to 6% today.
Almost 6% down today.
So
Almost.
Brian, a lot of nervous people. What would you tell them, or what are we doing at Irongate, more importantly, for our clients' money?
Yeah, great question. I had a conversation earlier this week with a customer, an older customer that's kind of new to investing, and she called me and asked if she should get out of the market. She saw her account go down over the last month, a significant amount. And I told her, I said, no, I don't think you should get out. And I opened up, I looked at her portfolio, I brought her portfolio up, and I said, you know, I've named off a half dozen of the companies that we own, and she recognized those names. She knew those names. She she was a customer of many of those companies. And I asked her, so do you think these businesses will be around 3 to 5 years from now, 10 years from now? And she says, oh yeah. And I said, well, that's probably the biggest reasons why you don't sell into this. These are great businesses that'll be around for a long time. I often talk about how long I've been doing this. I've been through a couple of these major corrections, the .com era in the late 90s, 2000, the financial crisis, and you guys have experienced a lot of that yourselves. And I've never bought into the idea that you can time the market, get out of the market, and then get back in with any sort of success. And my experience has taught me to own high quality businesses and own them over a long period of time. And yes, you have to accept a certain amount of volatility to reap those rewards by owning businesses, be invested in stocks, invested in businesses, be invested in the stock market. But I believe, and I am not selling my own stocks. Here's the other thing. I have not sold a single share. I've been buying, I've been buying a little bit lately. And we had another client text me, say, hey, do you guys still like Amazon? I said, yeah. Now, this is not a recommendation, but I went out and bought him a little bit this morning, bought a little bit more. So, that's our attitude. And then what's really happening, back to that question, people are nervous about inflation and interest rates. Those are the really two critical issues that people are paying attention to, investors are paying attention to, is high inflation and rising interest rates.
Let's take a look at that for those that are on the screen while we have a screen. Inflation rate 8.54%. The next inflation CPI number will come out next Wednesday, May 11th. So we'll see if this is peak or if it's going up. So you mentioned inflation, there it is. Of course, you see your mortgage rates there as well, climbing higher. And then here's the interest rates over here on the right-hand side that you mentioned. So the 10-year, almost 3%. So.
And 6 months ago, not 6 months ago, just a couple of months ago, that 10-year treasury was at 1.5, Spencer, that. What was it, 6?
Yeah, it wasn't very long that it was at 160 basis points. So 1.6, and Brett, that's just because there's a little bit of lag, but the 10-year treasury is now at 3.07 is where the 10-year's at.
Back in November, it was at 1.53. So it's basically doubled in the last 6 months. And
so you have
concerned,
you have, especially with, I think, this inflation number, right? Because the media is focusing on that 8.5% inflation, over 8.5% inflation. My wife, who does all the shopping in the home, she keeps overhearing conversations at the grocery store where couples are shopping and they're saying, nope, you can't buy that. It's too expensive. Or you can't do this, it's too expensive. We got to save our money. And you talk to people pumping their cars or trucks with gas. It's the same thing. Like, there's a fear because of this inflation, which we're seeing. And that fear obviously has made its way to the market. But you're telling people, even with rising interest rates and an inflation rate, don't sell the stocks you have. That's the message, right? Or buy more. Is that what?
Yeah, I listened to the Berkshire Hathaway annual meeting. Spencer, you need to chime in here, but I listened to the Berkshire Hathaway annual meeting this past weekend, and one of the questions that Buffett and Munger got was about market timing. And Buffett basically said, I've never been a good market timer. In fact, I'm a terrible market timer. What we're reasonably good at is identifying good value, a place to put our money where we think we'll get more back in the future, a return on our money in the future. He says, he feels like he's reasonably good at that. And he's never sold stocks based on what he thinks the market might do tomorrow, the next week, or even the 6 months of the next year. It's about identifying good businesses and recognizing you own a business, and sort of not forget that, that there's market volatility. There is, you have to accept that, but it's just really important to understand you own a business that if that business has a bright future, bright outlook, that makes a lot of sense. And so, when he talks about that kind of stuff, that just reassures me and what we are doing for our customers. We own great businesses. We're buying high quality. We feel like those businesses will be worth more 5 years, 10 years down the road, and to stick to the plan.
Yeah. So you talk about Warren Buffett, buy high quality businesses, which is our approach. And going back the last 15, 20 years, I don't know if I've seen Warren Buffett be more active in the market. Brian, what have you seen with Warren Buffett right now? What is he doing with his own money, right? And I say this because actions speak louder than words. And so what has Buffett been doing?
He's been buying. In fact, yesterday, they bought another chunk of Occidental Petroleum just yesterday. I think it was several $1 billion. More of Occidental. He's been buying Chevron. He's been buying back in the first quarter of this year. They bought back Berkshire stock. So over the last 2 years, he's been putting money to work. I think, from my observation, more aggressively than he has really the last 20 years. And my thought process is it's because holding cash in an inflationary environment is probably the worst investment that you can own, that you can have. And so he's putting money to work. So his cash is working for him. Where if you own a lot of cash, that money, if you think about it, owning say you had $100,000 a year ago and you got 8% inflation. So you have you have 92%, 92% purchase, the same kind of purchasing power as you did a year ago, just by owning cash because of 8 or 9% inflation. So that's what inflation will do to you. It robs your purchasing power over time. And where if you own a good business and has pricing power, which I absolutely believe we do, you have the ability to maintain purchasing power with those investments.
Yeah. So one other thing I'd like to share on my screen, but to set that up, you mentioned over time. You used that phrase, over time, right? And in the midst of a day where S&P 500, or the NASDAQ's down 6%, S&P, what's the S&P down right now, Spencer? Like 4%, 3.5?
Almost 4. Let's see where it's at right now.
It's down about 4
down four.
Oh, right here. It's on my screen.
4.35 right now in the exact moment, and
Um,
is almost to 6. So it's
The
accelerating.
VIX is up 27%. Like, it's total chaos. But to your point, Brian, over time, here's an S&P chart, going back to the 50s, and you can see all these little blips. And here's where we are right now. So as you kind of take a step back and you say, okay, well, over time, where are we? Well, we're this tiny little blip on the radar right here, which in comparison is nothing. That's not to make light of where we are, but it helps from a perspective.
Yeah, for sure. In perspective, it's like you said, there's the ebbs and flows of the market. And on days like yesterday, everyone loves the market. And on days like today, everyone hates the market. And when I say everyone, I'm making a general statement. But as I was talking to a client, and the challenge is, if you're wanting to get 5, 6, 7, 8, 9% returns, there's a price to that. I mean, that's just the reality of the way the world works, the way investing works, the way anything works. There's a price that you have to pay to get that. And we were looking at returns over the last few years, and the returns have been solid the last few years in the market in general, and Iron Gate's portfolios.
Yeah.
You can't be happy with a 15% return one year and then not expect there to be a price at times for that, 15% one year. And
It's a great point.
No one likes to pay the price. I don't like to pay the price. I mean, you don't, no one does, but that if we're not, and Buffett says it, if we're not willing to pay the price, then we should have our money in a bank account and earning 0.25% interest but then also being eroded with 8% inflation. So, we're losing money, but that honestly is investing in the stock market brings volatility. And though it stinks to do it, there's a price, and the reward on the other side, as long as you own these great businesses, in my mind, is well worth it. But these days aren't fun. Obviously, no one likes them. But it's like running 17s in basketball. I hated running 17s, but guess what? There was a price I paid to want to be able to have success, and it stunk. And days like today, that's the way I view it. Is these are the days that I have to pay the price, and I think our clients and investors in general have to pay the price if they want to have success in the future.
Yeah, these are tough times. There's no doubt. I mean, I don't want anybody to think that we're making light of the current situation. We take we take our jobs very seriously, and it's difficult when you have a day like today, and your account's down 4 or 5, 6%, something like that, or we're down, double digits on the year. Those are difficult times, no doubt. But during the financial crisis, that was another difficult time, and you just, my attitude was, we're going to get through this. Going through the financial crisis, we're going to get through this, and we stuck with our investments, and we did, and it turned out to be the right move. And we say this all the time, if you look at the history of the stock market, look at the history of economic activity in America and industry and business in general, business has continued to grow and build over time, despite a lot of challenging times in the past. We've had a lot of difficult times, and world wars and financial crises, high inflation. You look at the inflation during the 70s and early 80s.
Yeah.
That was a really difficult time. I was in junior high and high school, I was in high school in the early 80s, and I remember high inflation, but don't remember the impact on my own pocketbook. I didn't have any money invested, and so inflation just kind of went over the top of my head. I didn't understand it at that point, but we've been through these period of times before, and we will get through this. I believe that the best approach is to own, again, we keep talking about this, own just great high quality businesses with pricing power that will be able to fight off inflation through just their demand in their products and services. And it's a very difficult time, no doubt, and no one likes this. We don't like it ourselves, but
Nope.
the last thing I would just say is,
Go ahead.
the last thing I would say is, if you look out, 10 years from now, and look at your portfolio of businesses, I think you'll say, yeah, 10 years from now, I'll probably be fine. Now, maybe that sounds like too far ahead in the future, but even 5 years from now, I feel pretty confident that we'll look back on this time and say, yeah, it was a difficult time, but it was probably a good time to be putting money to work, putting money, and staying invested, not selling. Buffett's always said, if you sell stocks when stocks go down, you shouldn't own stocks. And I told that to this client I mentioned earlier today, that really, if you're inclined to sell your stocks, you're in business, that you own, when prices go down, then, you probably shouldn't be invested in stocks. And you should
one other thing,
really long-term investments.
Yep. Spencer, I can't see you, but I heard you.
Yeah, one other thing I was going to say, it was just the concept of, on days like today, I've never talked with someone who a year out from that day has said, I'm glad I sold my stocks. I've never heard, I honestly haven't. I've always heard people say either, I'm glad I didn't sell, or, man, I wish I wouldn't have sold. Because the hard part is, when you get out, you don't know when to get back in. And that's the really hard part. No one has any idea if the market's going to go down another percent tomorrow or go up 1% tomorrow. And it really is focusing on the businesses, like Brian said, and saying, are these businesses going to continue to do well in the next 3 years, 5 years, 10 years? But the regrets generally I've heard, in fact, I can say all the time when I've heard the regrets, it's been, I got too emotional and I panicked in the moment.
Yeah. Yep. And that brings up the last point I'll make is right now, this market is 95% behavioral. And what I mean by that is, Spencer, to your point, right? You got to check your emotions. You need to be calm. You need to look out 5, 10, 15 years. Yeah, volatility is the price you pay for returns. Howard Marks always says, Spencer, to your point, but you've got to be calm and just not make mistakes right now. And getting rid of everything and moving into cash, we would consider one of those mistakes. But checking your emotions, right? You have to do it as hard as it is. But as we look out, Spencer, 5, 10, 15, 20 years from now, what we've done with some clients that have financial plans is you and Matthew are reviewing those financial plans with people to help them understand and more or less, and you can tell me, remind them of where they stand and that they're going to be okay if they've already planned for it. Talk to me about that approach from looking up 500,000 foot view as to where people are.
Yeah, when I met with a client just recently, and obviously the market, it wasn't today, but the market has been down on the year so far. And so they expressed some concern about the plan. And they asked the question, well, is my probability of success within my financial plan, is it contingent on me, getting 9% a year on, like I've gotten previously the last 10 years or something. And we had to help explain to them, no, it's not. That when we're designing a plan, we build in downside scenarios. And when I say downside scenarios, I'm talking about recessions, no growth, high inflation. The software has the capability for us to build these types of scenarios in. And in terms of a simulation, include them when we're calculating probabilities of success. And so for people that have plans that we've done, and we've been like, hey, you're in a good place, you can feel confident about that. And you're like, well, what about now? Guess what? We've already taken these types of situations into account, and your probability of success calculated the probability of those things happening into it. So yes, you are still okay in your plan. And for those who don't have a plan, that's where it's the opportunity to.
Oh, we just lost him. I'm going to finish this sentence. It's the opportunity to get a plan from Spencer Matthews. So
I was on that call yesterday.
Were you?
With these clients? Yeah.
Oh.
And the plan does build in these scenarios. And that's why it's important to have a plan.
Yep.
And that's why it's important that any money you have invested in the market is not money you're going to need over the next 2 or 3 years. It's money that's 3, 5, 10 years down the road. And that's why it's important. We keep telling people that over and over again. This is not a short-term game. It's not a game, and one of the things that you brought up and Spencer brought up is, people have regrets over time about, you hear people, oh, I lost money during the financial, we hear that all, from time to time talking to people. I lost money during the financial crisis. Lost a lot of money during .com. And I think if you really look at those situations, I think 2 things likely have happened. Either they owned really poor, low quality businesses they were speculating, 1. Number 2, they sold when prices were down.
Yeah.
If you own high quality businesses, great businesses, pay reasonable prices, and you don't sell when prices go down, it's the probability of you losing money over a long period of time, I think, is pretty low. It's not 0, but I think it's pretty low.
Yep. Yep. And then filling your gas tank, right? That we talked about a few weeks ago, that a few clients like to say, which is putting money to work in markets like this. That's the other way to ensure that you, number one, don't lose money over time, or that you buy at the right price, right? So
Yeah, that's exactly what Buffett says and Munger
Yeah.
all the time, is they talk about when the market presents opportunities, being able to take advantage of those opportunities. And I can think about some opportunities that I was faced during 08 and 09 during the financial crisis. And it did have a big impact, not only in my bottom line, my balance sheet, but also on my clients' balance sheets in a positive way, that they were able to put money to work during those opportunities, even though it didn't, in the March of 09, it didn't seem like an opportunity. You know, the last 2 years, the market, been year and a half, the market had been going down consistently every day. It seemed like every day. And but being able to put money to work during those times actually had a real positive impact on, you know, my financial well-being over the long term, and also my clients.
Yep. And which is what we're doing now. We've had a lot of clients send us money last week, which is great.
Yeah.
So I'll steal a line from great American Ben Franklin. And this pertains to financial planning. It also pertains to what we do, Brian, which is portfolio management, which is, if you fail to plan, you plan to fail. Pretty simple, right? So it's important for our clients to know, and even those that are retired, we have a strategy. Those that are in the accumulation phase, we have a strategy. We're implementing it. Yeah, this stinks, but this too shall pass. And that's the important thing to understand. We'll get through this, and we hope as we do that your wealth has compounded even more. So with that, my friends, thank you for putting up with the Zoom podcast today. Brian, you there?
Oh, I'm there. Yeah, you cut out for a second. Go ahead.
Yeah, no, just wrapping things up. So thanks everybody for listening. Brian, any final words?
Just these difficult times. Again, think about the long term, and if you have money on the sidelines or have cash, this could be an opportunity. I think it will be. I mean, it definitely is an opportunity. I don't know if it's the best opportunity, meaning stock prices could get cheaper and there may be better opportunities.
Yep.
But again, that goes to timing, which is so hard. If you find something that makes sense, a good business at a reasonable price, and you think it makes sense, then I think you invest, despite trying to predict what the market's going to do.
Yeah. Look 5, 10, 15, 20 years down the road. All right, my friends, thanks for joining us today. Until next time. And remember, when the market falls 6% in a day, the best thing to do is to go golf or go for a hike, get some vitamin D, right? And relax. We got you covered here at Iron Gate. Thanks, everybody.
Thank you.